Every time I put on Humpback, I get asked similar questions. How does it work? How does it make money? Why would you put this on? And today I'm going to answer all those questions. Hey everyone, welcome back to Drawbridge Finance. My name is Levi Woods, and today we're going to talk about humpbacks, why I put them on, what they are, how they make money, and all that fun stuff. Now, before we get started, I just want to remind you this is an opinion channel only about money. I'm not offering financial advice in any way. So I'm a long-time trader. I've been trading options now for about 7 years. I guess that's not that long compared to a lot of people out there, but it is longer than some. So there's things that I have learned, strategies that I now employ in different types of IV environments. I have found that right now, in the end of 2020, this strategy has actually been working quite well. One of the things that we always look at as option traders is the IV environment, or the VIX. And we want to know how much volatility there is in the market. Now, the reason we look at this is because when there is more volatility, typically the premiums are richer. So as a premium seller, I can collect more premium even when the stock doesn't move a lot. Now, what's important is that fluctuation in IV, or implied volatility. And so one of the metrics that I like to track in my own portfolio is something called IV rank. And it's something specific to the stock. So what it does is it measures the amount of volatility relative to itself over the past year. So by looking at IV rank, we can determine when an underlying is at a heightened place and when the premium might be rich. Now, there's some stocks that I like to play all the time, and what happens is the IV kind of cycles through. The IVR moves up and down. And as it does that, there's times where I can put on a strategy like a strangle and it works quite well in a high IV environment. And then other months it might not work so well. The IV environment might be lower and I need to put on a different type of strategy. And that's where the humpback has had some success, because this year has been relatively high IV, but it's been moving around a lot as well. So let's take a look at it. I want to talk for a second about the volatility index. I get messages all the time about low IV. And let's be very, very clear. 2020 is not a low IV environment. If we look at the VIX here, today we're trading at 25.75, but this whole year has been relatively high. This purple line in the middle shows you the average VIX, which hovers somewhere between 17 and 18 over the past 10 years or so as we've been in a bull market. Now, when we talk about low IV environments, that would be in 2017. You can see here almost the entire year traded under 15 VIX. And even last year in 2019, we had a relatively long periods of time where the VIX was quite low. This trade is working in this relatively high IV environment where we're seeing a lot of bouncing around when we look at particular stocks. I'm going to flip over to my Patreon page and we'll take a look at a post that I've made, because I've put on 3 of these humpbacks in the last week. So we've got a couple of trades here, some iron condors, a little strangle, and typical trades that we put on in high IV environment. Some closed trades here. And what I'm going to look at is last week, November 6th, some Apple options. I'm going to enlarge it here for you. And we'll take a look at the trade itself and how I put it on and what it was doing. Here's the image from the trading platform that shows everything that I require to set up this trade. Now, please don't think that I have become some genius and I've made up this magical trade. I am sure there are tons of people out there that have traded this trade before, because it's actually really simple. It's a naked put and it's a diagonal call spread. That's it. It's just a 3-legged option. And I'm sure I'm not the first person to do it. I just couldn't find any good reference of it on the internet, so when I started to trade it regularly on my Patreon group, I actually needed a name for it. And because the profit loss chart kind of looks like a wave breaching over the break-even point, I kind of jokingly referred to it as a humpback, like a breaching whale or something like that, because I often refer to strategies as animals anyways. So that's why I use the term. If I'm wrong, if this trade already has a different name, please correct me. Leave a comment down below, because I have no ego about this. This is just what I call it for ease of use. So as I said, it's just really simple. We've got a naked put and then we've got a diagonal spread on the call side. So all of the options when I start the trade are out of the money. And the reason that I might want to put on a trade like this is because it can generate greater theta decay than a naked put by itself. And it can actually generate more profit. In this case, let's just look at where we were sitting. Apple was sitting at 1879. So this was a couple of days ago. December 18th was 42 days away. And I would typically look to place something like a strangle in this case. A strangle is very easy to set up. We just sell a put that's below the current price. And then I would sell a call that is out of the money as well or above the current price. This year, we've had stuff going up and up and up, and Apple is a great company. I believe that there is upside potential. So I'm a little bit leery to sell naked calls on a product like this. So what I do is I look for opportunity where I can sell the call and make the money off of it, but actually provide a little bit of protection to the call. So that would be simple enough. If we were setting up a strategy like a Jade Lizard, we would just sell this put, we would sell the call, and then we would buy, say, a 130 call down here. We would just buy the 130 call. We would be able to create a strategy that was profitable if the stock stayed between $112.50 and $125 for the next 42 days, which I'm expecting. And adding that protection works quite well, except it costs a lot of money. I'm only collecting $2.82 for the 125 call that I'm selling, and I would have to pay $1.56 to buy the 130 call. So that would limit my loss on the upside to the difference between the net credit received and the spread difference on the call side. Now, this video isn't about Jade Lizards. That's a totally different topic. Today we're talking about humpbacks. So what I'm doing is, instead of buying the 130 call for $1.56 that expires on the same day, December 18th, I'm actually buying the January 15th 130 call. And the reason that I do that is because the theta is lower. So I actually pay more money for it up front, $2.94. instead of $1.56, which seems a little bit counterintuitive. It means that I'm out of pocket more money at the beginning, which would lead you to believe that I'm going to not make as much money on the trade. But we have to remember that this date affects these options in a different way. So when we get to the expiration date of December 18th, there's still a month left in this call, which means that if the stock is trading in our range between 112.50 and 125, that there's going to be value left in the long option that I'm paying for. So what I hope is that there's enough value left there that I can actually sell that off for additional credit and make more money on the trade. So if we were to take a look at a profit loss chart just of a naked put by itself, if we were to open this trade for $2.80, the maximum profit would be $280 minus fee. And this profit loss chart would come up here, and then it would just be straight across. So in this case with the humpback, I'm actually creating a little bit of risk on the top side, but it is limited, which is what I like about the trade. I could sell the put for $2.80, and that would be my max if it was naked. When I add this diagonal call spread, I'm actually collecting enough credit that my opening credit is only slightly less, $2 and around 70 cents. So let me just see what I actually filled this for. I got $2.68 is what I actually was credited on the trade. So now we know that what I'm opening, the humpback, December 18th, it's the negative 112.50 put and the negative 125 call, and then I've got this protection in the later date. My original transaction date is November 6th, and the implied volatility rank is 21. Now that's where the beauty of this comes in. Because I own a long call, if the volatility rises, the value of that long call is actually going to increase as well, which means this could potentially drive up that credit that I'm trying to get out of Apple when I sell off that long call to close the trade. The initial credit per contract is $2.68. And that's why I've been loving these trades, because I'm actually getting a significant credit to open this. My break even is nearly identical to putting in just a short put, and I get the benefit of the theta decay from the short put, the short call, and it's only costing me the theta decay of the long call in January. There's a total of 3 options in this strategy. I'm putting on a single contract, and the margin requirement in US dollars is around 3,500, which would be similar to the margin requirement of putting on a naked put. So it's very, very similar to a naked put. If I'm using my quick options calculator, it actually projects a simple annual return that's quite low, only 65%. I usually aim for around 100% on that, but that's okay with a humpback, because the expectation is if I'm right and the stock's gonna go up, then If it can get anywhere close to this 125 mark, I'm actually going to realize an additional credit to close the trade. So my max return is going to be $526. Now I made 268 on open, which means I'm going to open for a credit for 268, and then I'm going to close it for an additional credit to make this max profit. And that's where this trade works extremely well, is where the stock actually goes up. Now, one of the things I love about the Humpback is its defense. If we look at what happens if the stock suddenly starts to come down, if the stock price starts to come down under this 112 mark, then I'm going to be into a loss zone, and I don't want that. But what I can do in that case is I can buy back the call because it will be worth less money. I can sell the long call because it will still have some value because it's a longer date. And then I would be in the exact same position I would be if I was just selling a naked put. And that's one of the easiest strategies to manage because we can just roll it out in time indefinitely. And it's again why I only play stocks that I'm bullish on or that I wouldn't mind holding if the price was right. So the real question becomes, when do I put it on? Now, Apple has kind of been trading in this IV rank, kind of bouncing around between like 20 and 40 relative to itself. So on this particular day when the IV rank was only 21, although it's still relatively high, I felt like there was room for it to expand. And that's where I would look to employ a strategy like this. Now, this is definitely not a beginner's strategy. Diagonals can move around a lot because there's two different things going on. Because we have different expiration dates and different strike prices, and they work in different IV environments because of the date change, the prices can actually move quite a bit. So it's really hard to determine what the exit strategy is on this, and that's what makes it not a beginner strategy at all. Typically what I want to do, and my hopes and dreams, is that Apple is going to just nicely drift up here right to the 125, and just before Christmas, before December 18th, it's going to be trading right around 125. The IV is actually going to be elevated from its current state, and I'm going to give myself a really nice Christmas gift by closing this option transaction early for an additional credit of around another $200. I think that would be a reasonable target for me if the stock is performing the way it's supposed to. Now, if it doesn't, I may be happy to get out of this for 0 extra credit. If I can close this for nothing, then I've collected my original 268 and I've done exactly the same, which is slightly less than I would if I had sold a put. And we can see by this curve that for anything above 112 is actually going to increase my profit. So I'm going to hold this as long as I can, because that's the whole idea of this trade, is that I hold it for duration and that I hope that Apple stock just keeps drifting up and up and up. I hope this video has been informative to you. I hope it answered some of your questions. And if you have any questions or comments, please leave them down below. Remember, it helps my channel a ton if you give it a like and a thumbs up and a comment and all that fun stuff. And if you haven't subscribed already, please do, because the whole goal of this channel is so that we can get rich together. Thanks so much, and we'll see you very soon.